Welcome to our channel. Today we are diving deep into a common saying that is buy low, sell high. What does this mean for investors, especially when markets are at all time high? Are we near a crash, or let's break it down through three different lenses? Okay. First, let's understand the market high. What is market high, all time high? First, let's talk about asset growth over time. Whether it's a real estate, gold, or equities, this asset tend to reach new all time high repeatedly. For example, aiming for a 12 to 15% return on equities aligned with GDP growth and inflation, this translates to doubling every 6 years. So, if the Sensex is at 77,000 now, a 12% annual return would mean expecting it to reach 1,50,000 in the next 6 years and close to 2,80,000 in next 12 years. Remember, hitting all-time highs is just a part of this journey. If we see the historical performance, so let's talk about the numbers. Over the years, the Sensex has consistently hit new highs from 34,000 in 2017 to nearly 77,000 now. Our research shows that even if you only invested at these peaks, the average return over the next year was about 14%. There's a 60% chance of return exceeding 12% and a 50% chance of surpassing 15%. So, historically, worrying about all time highs hasn't been beneficial. So let's learn about the opportunities for new investments. So, what about investors looking to deploy new money now? What should they do? This is a market which is highly in favor of the individual investor because the individual investor does not have portfolio complication to manage, and he can look at bottom up opportunities without having liquidity concerns because you can pick stocks which are reasonably priced, where the future looks quite bright and investors are not really focusing on these pockets. So, also in our judgment, it is not valuation that prevent downside. It is really earnings growth which prevent downside and the situation that the economy find itself in today as also the corporate as a culture. As a result, we feel that there is a earning tailwinds which has not been seen in quite a long period of time, and those tailwinds will ensure that downside will be limited in this market. Look for the stocks that are reasonably priced with bright futures, especially in the sectors like manufacturing, capital good, and defense. The rural sector also holds promise with significant potential in discretionary players. Financials, particularly housing finance, are attractively priced too. You could find opportunities in banking space in the 5 to 10 times pricing to earning rate. We would not call that expensive by any measure, so there are reasonable opportunities in the banking space. So there are tailwinds in the market. Prices are attractive in many sub pockets of the sectors, and we do not think that this is an uncertain space where uncertainty should be attractive for the investor because prices are low because of the uncertainty, and so we are definitely positive on this space. So, which type of fund should investors look at if we talked about the mutual fund thing? Across all stock market, India continues to be a bright spot. The confidence of investor is high as Sensex is surging day by day and touching new highs. The key is to set the expectation right in the present market condition and remain disciplined. The uncertainty around the world is very much there, and hence going gradual with the investment will be better way to invest. When market are at all time high, choosing the right type of fund becomes crucial to balance potential return. So let's learn about the funds. Which category of fund you should invest in? The first one is multi-asset fund. What's the overview of multi-asset fund? Multi-asset fund invest in a mix of asset classes such as equities, debt, and gold. The allocation is actively managed to optimize return while minimizing risk. So why it is a good time to invest in multi-asset fund? First point is diversification. By spreading investment across various asset classes, this fund reduces the risk associated with any single asset class. Second is stability. The presence of debt and gold can cushion against the volatility in the equity market. And the third one is dynamic allocation. Fund manager can adjust the allocation based on the market condition, which helps in mitigating risk at market peaks. The, the second fund we can talk about is balance advantage fund. BAF, which is commonly known as, is dynamically adjusts the allocation between equity and debt based on the market valuation and condition. They use model to decide the proportion to invest in equities and debt. So why it's a good time to invest in BAF? It's dynamic risk management. The fund allocation strategy reduces the equity exposure when valuations are high and increases it when valuations are low, protecting against the market. The mix of equity and the debt provides growth potential while offering some downside protection. And the best part is tax efficiency. BAF can be more tax efficient compared to regular rebalancing of the DIY portfolio. Third fund we can talk about is ICICI Prudential Bharat Consumption Fund. This fund focuses on companies benefiting from the consumption theme in India, including sectors like FMCG, automobiles, and consumer durables. So, why is a good time to invest in Bharat Consumption Fund rightly? Sectoral growth. The consumption sector often saw consistent growth driven by demographic trends, increasing disposable incomes, and urbanization. Defensive nature. Consumption stocks are generally less volatile and can be more resilient during market downturns as people continue to spend on essentials. As the Indian economy grows, consumption driven companies are expected to perform well, providing steady returns. And the last one fund which can we can think about it currently situation is manufacturing fund. This fund invests in companies involved in manufacturing sectors, including industrial, capital goods, and related sectors. So, why it's a good time to invest in manufacturing fund? Manufacturing fund is closely tied to economic growth. As economies recover and grow, manufacturing companies tend to benefit significantly. And the government initiatives, policies like Make in India can provide additional tailwinds to the manufacturing sector. While the sectors can be cyclical, manufacturing companies can offer substantial growth during economic expansion. With the existing portfolio, what should be the approach for that? Let's learn about that. For those with existing portfolio, there is no need to go over underweight on equities. Instead, check if you need to rebalance or not. If your equity allocation has exceeded your target by more than 5%, rebalance it back. For example, if your intended allocation is 80% and now it is 85%, 86%, so move 5 or 6% back into debt. So what how to reduce the last question is how to reduce risk in the overall portfolio in these times. To reduce risk, diversify across asset classes. Don't be 100% in equities, include some debt. Within equities, diversify across different styles and avoid overloading on expensive small caps. Rebalance periodically, stagger new investments through SIPs mode. Finally, ensure your investment time frame is at least 7 years to mitigate risk efficiency. Thank you for watching. Remember, all time highs are part of the market journey. Stay informed